They didn't just dip silver this week. They tried to train you to hesitate. On the screen, price got hit. In the real world, the cost of getting metal didn't relax the way you think it did. That's what happened. Paper flashed discount. Physical whispered, good luck. You're here with us, and we don't waste your time. If you've been waiting for a clean pullback so you can buy like it's still easy, snap out of it. The bargain window doesn't close gently, it slams. And when it slams, it doesn't announce itself. You only notice when you try to buy and the shelves look different. This is educational. We manage risk. Now watch the trap. Most people think a lower chart price automatically means cheaper silver. It doesn't. Not when the pipeline tightens, not when premiums stretch, not when delivery times get weird, not when the price is a number on a contract, but the cost is a box that has to show up at your door. Two silvers exist at the same time. There's paper silver, fast, liquid levered, emotional. It trades like a casino chip. And there's physical silver, refined, fabricated, insured, shipped, delivered. It trades like oxygen when people start panicking. Those two markets talk, but they don't always agree. And when they disagree, the chart can go down while your checkout total goes up. That's the punch in the mouth. So what actually happened? We saw a surge that forced everyone to look up. Gold ripped. Silver didn't politely tag along. It jumped like it smelled fear. Then the market did what it always does when it wants you quiet. It hit the price hard intraday, shook the tree, and tried to make the strong hands doubt their own plan. But here's the part that matters. If this was over, those sell-offs would have broken the structure. They would have rolled into follow-through. Buyers would have vanished. Instead, time after time, the dip got absorbed. Not celebrated. Absorbed, like something bigger is using volatility as cover. And that should make you lean in, because volatility near the roof is not the same as collapse near the floor. A market falling apart looks weak into the close. A market being stress-tested at altitude looks violent, and then refuses to die. Silver is doing the second one. Here's the question that splits the room. Are you waiting for a lower number, or are you waiting for permission? Be honest, because most waiting isn't strategy, it's psychology. It's a person watching the crowd, hoping the crowd will make the decision for them. They want headlines to say it's safe. They want experts to agree. They want the chart to feel comfortable. And silver punishes comfort seekers. Silver doesn't reward the person who wants the perfect entry. Silver rewards the person who respects the plumbing, the pipes, the pressure, the way supply chains actually behave when demand gets jumpy. Here's where it gets sneaky. Holidays, weekends, thin sessions. That's when metals become predators. You think you'll act when the market reopens. Metals don't need your schedule. They trade globally. They move when you can't click. They gap while you sleep. Gap risk is real. And in metals, gap risk is not theoretical. So if you're telling yourself, I'll buy Monday, understand what you're really doing. You're gambling that nothing important happens while you're off the field. Now let's make this practical. Suppose the paper price drops $5 on a flush. Comment sections cheer. Sale, then you check real inventory. Limited, pre-order, delayed shipping. And the premium is wider than last week. So what did your dip buy you? An illusion. You saved nothing because the supply chain charged you back the difference. That's what happens when a market starts to smell a supply problem. The chart is one layer, the physical pipeline is another layer, and when pressure rises, the pipeline tells the truth first. Now, some of us will say, fine, I'll just buy an ETF and avoid premiums. Paper exposure can be useful. It's liquid, it's fast. It lets you move, but paper exposure is not ownership. In calm markets, that feels like a detail. In stressed markets, that detail becomes the whole point. So decide the job. If you want speed, paper can work. If you want hard money with no counterparty, physical matters. We can do both, but we don't confuse them. Here's the mistake most people make. They think they can wait until the story is obvious. They think they can show up late and still get early prices. That's not how scarcity trades. Scarcity trades in two phases. Phase 1, the chart moves, and everyone argues. Phase 2, the product disappears, and nobody argues anymore. Most people only believe phase 2 after it hits them personally, after they try to buy and realize the market isn't offering them normal conditions. Now, let's talk about the psychology war, because it's designed, not accidental. The mainstream cycle is always the same. They ignore the move, then they mock it, then they explain it away, then when it keeps going, they warn you it's too late and you're the last buyer. The goal is not accuracy, the goal is paralysis. Paralysis keeps you controllable. So we stop outsourcing our conviction to daily headlines. We watch mechanics. Mechanic 1, volatility clustering at highs. Mechanic 2, dips that get bought without celebration. Mechanic 3, premiums that refuse to cool down even when spot cools. Mechanic 4, delivery times that stretch quietly. Those signals tell you more than a talking head ever will. Now let's zoom out, because silver doesn't move in a vacuum. Silver is an amplifier. Gold is the steady warning. Silver is the megaphone. When silver starts behaving like a coiled spring with a jet engine, it's not just speculation. It's the market sniffing something deeper. Trust pressure. Trust in what? Trust in policy. Trust in fiscal discipline. Trust in the currency's purchasing power over time. Trust in the idea that the people in charge have a clean exit plan. When that trust wobbles, hard assets don't ask permission. They get bid. And no, we're not gambling. We're measuring. Here's the measurement. When a currency's supply expands faster than real productivity, purchasing power bleeds. That's arithmetic, not ideology. When purchasing power bleeds, metals priced in that currency tend to rise because metals don't dilute themselves on a printer schedule. That's why gold can scream even when the headlines say everything is fine. If everything was fine, gold wouldn't be acting like a siren. If everything was stable, silver wouldn't be ripping and snapping back and ripping again. Metals are a message, not a mood. Now, the bond market is the elephant in the room, because when the stress moves from private balance sheets to sovereign balance sheets, the playbook changes. When consumers crack, you can blame them. When banks crack, you can bail them out. But when government credit becomes the stress point, the escape routes get uglier. And that's when hard money becomes less of a hobby and more of a shield. So here's the uncomfortable scenario we need to keep on the table. Not a promise, a risk. If the next big stress event is about sovereign debt credibility, money doesn't tiptoe. Money rushes. Institutions reposition. Portfolios shift. And when that shift happens, the demand doesn't drip. It allocates. Allocations are big. Allocations create gaps. Allocations turn pullbacks into brief wicks that vanish before you can react. That's why waiting for a gentle invitation can be a losing strategy in silver. Silver's market is not infinite. It can feel deep on paper and thin and physical at the exact same time. That's not a contradiction. That's the structure. Now let's talk about miners, because this is where people get emotional fast. Physical is about ownership and protection. Miners are businesses. They can be mismanaged. They face political risk, operational risk, dilution risk. They can blow up for reasons that have nothing to do with silver's price. So we don't worship miners. We analyze them. But here's the leverage. Once price moves far enough above a miner's costs, every extra dollar doesn't add $1 of profit. It can add multiple dollars of free cash flow. That's operating leverage. It's a light switch, not a dimmer. That's why miners can look sleepy, until earnings force the market to wake up. And that's also why you can see miners get slapped on intraday metal dips and then roar back by the close. That's not the business collapsing. That's forced selling, confusion, and disbelief. It's the market admitting, we still don't trust this new regime. When belief catches up, repricing gets violent. Now, here's another subtle detail. Many gold miners produce silver as a byproduct. When silver runs, it can fatten margins in places analysts don't model. That's why the market can suddenly re-rate names people ignored for years. But none of this matters if your plan is built on one fantasy. I'll just buy lower later. So let's challenge that fantasy the right way. If silver dips, will you be able to get size without delay? If silver dips, will premiums cooperate? If silver dips, will inventory be there? If silver dips, will it happen while you can act? Or will it happen as a weekend gap that turns into a Monday chase? Those questions force thinking, and thinking keeps you in control. Now I'm going to say something sharp because we need honesty. A lot of people don't actually want a better price. They want emotional comfort. They want to feel smart. They want to avoid regret. But the market doesn't care about your regret. The market doesn't care about your pride. The market cares about positioning versus pressure. And right now, pressure is rising. You can see it in the way sell-offs don't stick. You can see it in the way big red candles get erased. You can see it in the way silver refuses to behave like a finished story. So what do? We simplify into a framework we can execute. First, pick your lane. Physical, miners, paper, or a blend. Second, if you're buying physical, stop staring only at spot. Watch availability. Watch premiums. Watch delivery times. Those are early warning signals that paper price is lying to you. Third, if you're using miners, size accordingly. Expect volatility. If you can't sleep holding it, you're overexposed. Fourth, watch credibility signals, currency pressure, policy surprises, bond market stress. Those are the fuel sources. Fifth, stop waiting for a headline to validate you. Headlines validate you after the easy part is gone. Now, I want you engaged with us, not watching this like a spectator. Question 1 for the comments. Are you buying at these levels or are you waiting for a dip? One word. Buying or waiting. Question 2. What lane are you in right now? Physical, miners, both, or neither? And why? And while you're here, do the simple thing that helps us keep pushing original work. Hit subscribe. Short and effective. Subscribe now. Because here's the truth. This market doesn't need you. You need a plan. And we build plans together. One misconception keeps wrecking people. They treat silver like a stock with infinite float. It isn't. A stock can split and issue more shares. Silver has to be dug up, refined, minted, moved. That's a physical chain. And a physical chain doesn't speed up because a chart turned red. So when paper price gets smashed in minutes, ask the only honest question. Did anyone create more real metal in those minutes? No. The paper market changed emotion. The physical market stayed stuck in physics. That's why paper smashes work. They don't just move price, they move you. They make you feel like you can wait. They make you feel safe. And while you wait, somebody else quietly accumulates. Now watch the premium trap. Premiums don't rise only because dealers want more. Premiums rise because the marginal unit is harder to replace. Restocking terms worsen. Shipping costs jump. Inventory risk rises, so premiums widen to keep the pipeline alive. Fact, premium is the stress gauge. Interpretation. When premiums stay firm during a spot dip, the dip is paper relief, not physical relief. If you've lived through a hot phase, you've seen it. Spot ticks down. Comment sections celebrate. Then you see max 2 per customer. You see ships in 3 and 4 weeks. You see call for availability. That's not normal. That's rationing in slow motion. And rationing doesn't start with headlines. It starts with friction. A limit here, a delay there, a premium that refuses to cool. Then, one day, a gap higher that never fills. Here's the macro layer, clean and simple. Debt has to be financed. Financing pressure creates policy incentives. The path of least resistance is almost always currency dilution over austerity. They won't call it dilution. They'll call it support. But the result is the same. More currency units chasing the same real stuff. And real stuff reprices. That's why metals can scream while the headlines say, everything is fine. If everything was fine, gold wouldn't be flashing. If everything was stable, silver wouldn't be acting like a coiled spring with a motor strapped to it. Now, a question we need to face together. If we're wrong, where will it show first? Not on a tweet, not on a talking head. It will show in physical signals. Premiums collapsing, inventory flooding back, delivery times shrinking, volatility dying. Until we see that, we don't assume the story is over. So stop anchoring to a magical number. I'll buy at X is not a plan. It's a wish. Build a method instead. Stagger entries. Keep dry powder. Avoid all indecisions that force you to be perfect. We're not trying to win a screenshot. We're trying to win the cycle. And here's the simplest metaphor in the whole breakdown. Think of silver like a crowded theater. Paper silver is the ticket stub. Physical silver is the seat. When everyone is calm, the stub and the seat feel interchangeable. When smoke shows up, only the seat matters. So ask yourself, are you collecting stubs or are you securing seats? Because the move that changes everything rarely happens when it's convenient. And don't ignore institutions. Retail buys in ounces. Institutions buy in blocks. They don't average in emotionally. They allocate. And allocations can turn a normal-looking chart into a launch pad, especially in a market as tight as silver. Miners are the leverage lane, but we stay selective. A miner is a business, not a bar. Management matters. Jurisdiction matters. Dilution matters. If you want miner exposure, ask, can this company survive a nasty drawdown, or does it need constant new shares to breathe? If price spikes, does it actually keep the upside, or is it trapped in bad contracts and bad decisions? We're not gambling. We're measuring, and we act before the crowd demands proof. So if you're waiting for the media to clap, remember, they clap after the move. They ring the bell when the easy seats are gone. We'd rather look early, move calmly, and let the math do the talking for us.